Today I want to talk about the US, its debt problem, and how it's going to affect your portfolios. Now, although it's the US's debt, it's going to affect everyone. Much like the dot-com bubble and the great financial crisis had its origins in the US, but affected everyone. I'd like to start with the first slide, an anecdotal slide. If we look on the left, we can see the S&P 500 index performance over the 70s. It topped out in 1973, and over the following 2 years, it dropped 45%. On the right, we have the S&P 500 index in the 2020s. And what I find interesting is that the pricing structure is quite similar. What I find more interesting, though, is that over the same period, in the 70s and the 2020s, how US inflation has followed a very similar pricing structure as well. So it makes me think, what if inflation today continues to follow inflation of the 70s? Will we have a big market pullback in the US and globally like we had in the 70s? And what could cause inflation to go higher again from here? Maybe not to the 14%, but maybe the 4 to 5%, which is already double the Fed's current target of 2%. So what could cause inflation to go higher from here? High commodity prices, whilst very difficult to forecast, it is a possibility. Obviously nothing as, well, I wouldn't expect anything as high as the oil shock we had in the 70s, but it is quite possible. But given that it's difficult to forecast, let's say maybe. Housing prices. Currently, affordability for housing in the US is quite low. It's difficult. It's not very affordable given the median incomes relative to the median house prices. But let's say maybe as well. The Fed prematurely cutting interest rates. People like us, voters, we like lower interest rates, and it is an election year in the US coming in November. So we think this is likely. The Fed is supposed to be independent from the Oval Office, but we've seen in the past this not to be the case. What about high US government debt? More and more debt that is pumped into the financial system. At Flagship, we think this is quite likely. Now, what do we mean by more and more debt? Well, currently the US government debt levels are sitting at $35 trillion. This is a massive number, which I'm going to try to put into perspective for you. Let's assume $1 equals 1 second, or $60 equals 1 minute. How long do you think $1 million is? It's 12 days. $1 billion? 32 years. And $1 trillion, that's 32,000 years, which brings us to $35 trillion is equivalent to 1 million years, which is a very, very long time. Now, I'm going to spend the rest of this presentation talking about how the US got here, this massive $35 trillion of debt, the 3 choices that the US has, and the very 3 different effects it will have on your portfolio, depending on what choice the US makes. So George Washington said, debt is the greatest slavery. And if we look at the left there, we can see how the US government debt has evolved over the years. It started in the 60s, pretty negligible, had a bounce in the 80s, and then started growing exponential in the early 2000s. Now, the first national debt, post-American Revolution, was issued in 1790, ironically by then President George Washington, with a face value of $11.7 million. Over the next 224 years, from 1790 to 2014, that debt has totaled $17.5 trillion. That's 224 years. Over the next 10 years only, from 2014 to 2024, that US debt doubled to another $17.5 trillion to $35 trillion. So how did the US get here? Well, for starters, the US spends more money every year than what they earn. And this is termed a deficit, and this deficit is funded by debt. So to look at a practical example, or a written example of how a budget deficit occurs, let's look at the March budget for 2024, the US's budget. We can see on the left the total revenue for March for US as a government, which is almost exclusively from tax receipts, was $332 billion. Now, everything to the right, which is in red, is total expenses, and total expenses totaled $566 billion. This left a shortfall, or a deficit, of $234 billion. And this deficit, was funded by debt. Now, I think it's worth noting here that the total revenue of $332 could only barely cover the three mandatory spending categories of Social Security, income security, and national health. It couldn't cover anything else. It couldn't cover the category of interest expense, of defense, of Medicare, of transport, of construction, etc. So the very important point I want to make here is the US had to issue new debt, that $234 billion, to cover the interest expense on its existing debt. And this is a red flag for us. I mean, if I think of it in a day-to-day life, and for me and you, in context, imagine if you had a credit card and you max that out this month, and you now have to pay the interest on that credit card, but you've got no more money. You're then going to get another credit card. You're going to put up debt on that credit card just to pay off the interest on the first credit card. Obviously, that second credit card is going to get maxed out over time, and then you're going to need a third credit card to pay off the interest on the first and the second credit card. And remember, this is just the interest, not the principal payment. Now, deficits aren't new to the US. They've been around since at least the 60s. The last budget surplus was in 2001. Since then, the US has had uninterrupted budget deficits, and some of them have been significant. What hasn't helped has been the financial shocks of the 9/11 and the wars that came after that, or the great financial crisis in 2008, and the financial bailouts that were required for that. And then the pandemic in 2020, which had helicopter money, where the government gave money to US citizens. What is very disturbing, though, is that even in 2023, which was a very good economic year for the US, GDP was strong, unemployment was very low, they ran a very massive deficit of $1.6 trillion. This should have been a year where they ran a surplus and paid down debt. Now, some very prominent people are sounding the alarm bell on the US government debt levels. So looking at these six people, what are some of the similarities that you see when you're looking at these people? Well, number one, they're all very wealthy. Even Jerome Powell, he's worth between $100 and $200 million. He was a partner at private equity group Carlyle before he became Fed chair. The rest are multi-billionaires. The second similarity is that these are probably six of the most knowledgeable people in finance and investments today. At the top left, we've got Stanley Druckenmiller, probably one of the best macro investors out there today. He says the US debt crisis is worse than I imagined. Next to him is Ken Griffin, founder of Citadel, one of the more successful hedge funds out there. He says no one is planning for high interest rates, which is what we have now. On the bottom left, we've got Ray Dalio, founder of Bridgewater, the world's largest hedge fund. He says America is facing a huge or big cycle debt crisis after an insanely free money environment. This refers to the long period in probably the last 15 years of where we had almost zero or close to zero interest rates. Next to him, we have Larry Fink, who's the founder, chairman, and CEO of BlackRock, the largest asset manager in the world. And he says the US cannot take for granted that investors will continue to buy US debt in the same size and at the same price. And then we have Jerome Powell and Warren Buffett, who agree when they say the US government's finances are unsustainable. So if these people are worried, I'm listening. Now, when we think about debt, debt is not necessarily a bad thing. It can be a good thing if used productively. And a clean and simple way to measure this is looking at the ratio of US debt to GDP. And a good measure would be seeing this ratio going down. Unfortunately for the US, this measure has been going up. In 2024, the ratio was 120%, a level last seen since the end of World War II. And the US's own Congressional Budget Office expects deficits to continue straight through to 2053, and for that ratio to reach 200%. It's worth noting that the forecasts that the CBO does use are conservative. There's no recessions in those forecasts, and there's no pandemics or financial crises. Before I go to the next slide, I just want you to notice that debt and debt to GDP came from very low levels and started creeping up from 1980 onwards. Here I'm showing the US's funding rates or borrowing rates. This is the rate at which the US government borrows money. Why am I showing you this slide? Well, you can have a lot of debt. Let's say you've got the $35 trillion of debt, but if your interest expense is zero, your interest payments will be zero. So then interest isn't really a problem. Now we can see the US has been quite fortunate because as debt levels started increasing from 1980, you can see that their borrowing rates came from a high from 1980 and started coming down. So as your debt went up, your interest rates came down, and that sort of kept a lid on your total interest payments. However, as you can see on the left, as inflation started going up in 2022, interest rates started going up. And now you've got a problem because now you've got high debt levels and you're starting to get higher interest rates. So what do you think happened to interest payments or interest expense? Well, they skyrocketed. The US is now currently spending $1 trillion per year on interest payments alone. And to put this into context, this is the first time that the US is spending more on interest payments, and this is not on paying off interest debt or the principal, but just on the interest. This is the first time that they're spending more than they are spending on their entire defense budget. So this is another red flag for us. So this brings us to what I'd like to call the debt cycle. The US government is spending more money on social security, income security, defense, and now interest, which is leading to larger deficits. Larger deficits needing to be funded by more debt. All else being equal, more debt equals more inflation, as there's more money getting pumped into the system. Higher inflation causes the Federal Reserve to hike interest rates. High interest rates on debt equals larger interest expense. And because the US doesn't have money to pay that interest expense, they have to raise more debt. And more debt goes back into larger deficits. And so it goes on. So the US is in a very difficult place and is effectively trapped. Now, we're going to shift gears a bit here, and I'm going to, next 4 slides, I'm going to talk about the supply and the demand of US debt. Now, bear in mind, once the debt is issued, once the US government has issued the debt, that debt changes hands and trades on public markets, much like a stock exchange, but for debt. So it's important to consider the supply and the demand of US debt. Now, all current outstanding US debt is going to mature sometime in the future, sometime between now and 30 years' time. Some debt will mature in 1 month, 5 years, 10 years, etc., up to 30 years. Now, if you are the US government, you'd like to see a nice, evenly distributed maturity cycle, meaning that if you have a lot of debt, $35 trillion, you want to pay that off evenly over the next 30 years. Unfortunately for the US, its maturity profile doesn't look that good. Half of all its debt, outstanding debt, is due in the next 2 years. So that is a lot of debt that is coming up in a short space of time, and that's what I'd refer to as the supply of debt. And this is coming, unfortunately, at a time when there's some big holders of US debt who have been reducing their holdings. If we look at China, for example, they used to be the biggest holders of US government debt, and they've been reducing their holdings since at least 2018, and more aggressively so since 2022. We can also see Brazil and Saudi Arabia have been reducing their debt. And this goes back to what Larry Fink was telling us from BlackRock, is that the US cannot take for granted that people will still want to buy their debt in the same size and at the same price. And this will have consequences later. So we've got a lot of supply that's coming to market of US debt, whilst we have some large holders of US debt which are reducing their holdings. Now, bear with me for a second when I show you this next slide. This looks at gold's relationship to US real rates. And that's been there's been quite a good relationship over the years, but that broke down in 2022. And that coincided with the Russian and Ukraine war. Shortly after that war started, the US imposed sanctions on Russia, effectively freezing all their foreign assets, including the Russia's US debt assets. So this is an asset for Russia, and it is a debt that the US has owed Russia, along with the interest that it needs to pay on it. Now, if you are China and you're looking at this from the outside and you're seeing that the US has frozen debt that it owes Russia, if you were China, would you be buying more US debt or would you be selling? And if you were selling, what would you be buying with those proceeds? And the answer is, in part, you'd be buying gold. China has been buying gold, as have the other central banks around the world. The Russian-Ukraine war started in Q1 in 2022. And after that, we can see how central banks around the world have significantly increased their buying of gold in 2022, 2023, and on track for a strong 2024. So to recap of what we've spoken about up to now, one, the US has too much debt, which is evidenced by the fact that they need to raise new debt just to pay the interest off on their existing debt. Two, they're running deficits, and the CBO expects them to continue running deficits. Running deficits means they need to fund that with debt, so they're going to have more debt on the current large size of debt. Number three, they're not using their debt proactively. And number four, there's a lot of supply of US debt that's coming to the market in the next 2 years at a time when the demand profile is changing. So what is the path forward? So there's three ways forward. The US can cut debt. That will be the right thing to do, but politically unpopular, as it will mean they need to cut into social spending, defense spending, and other social services. They can do nothing and let the debt levels continue creeping up as they have for the last couple of decades, and effectively kicking the can down the road. And then thirdly, there could be another financial crisis or another pandemic such as COVID, where they need to issue a lot more debt. Now, all three of these scenarios will have three totally different effects on your portfolio. Now, I'm going to come back to this slide, but first I just want to talk a bit about Flagship. So Flagship is an experienced global investment manager. Flagship's first fund was launched in 2001, and it was a global fund. And ever since then, Flagship's main focus has been global. I would say the vast majority of South African asset managers, when they first started investing locally, and later in their timeline, they ventured or started looking at investing globally. So where global investing is our DNA, we think that sets us apart from many of the other SA investment managers. We have a 20-year track record of outperforming the benchmark. We're one of the most awarded boutique asset managers. We're independent, owner managed, and we have flexible strategies, which means we've got the tools necessary to navigate the current markets. Our investment approach, risk management is probably our number one goal or our number one aim. This allows us to, one, protect client capital, and number two, removes a lot of the emotion that comes with investing. We are style agnostic, which means when value as a style does well, we can do well. When quality as a style does well, we can do well, and the same with growth and with GARP. We can do well in all the different style scenarios. It also means that we don't define ourselves to looking at just emerging markets or just developed markets. We look globally for the best opportunities and are not constrained in any way. We use a top-down and bottom-up approach. Stanley Druckenmiller and George Soros are extremely successful investors, and they are just top-down only investors. Warren Buffett and Peter Lynch, they're bottom-up investors only, and they also have been extremely successful. So we decide we get a lot more information using both top-down and bottom-up. We typically hold 40 to 50 stocks in our portfolio. In the flexible funds, we've noticed that equities over time are the best performing asset class. So we do have a bias towards equities. You could say we are equity centric, but we're also flexible enough, meaning that if we need to, we can reduce that equity allocation quite quickly and quite materially and increase cash allocation. Our decision making is collaborative, which means it's a team approach, and there's not just one person's view that's expressed in the portfolios. And our flat structure means that we are nimble and we can act quickly. This is probably the biggest advantage for a boutique. This is the Flagship Worldwide Flexible Fund and some of the stocks that the fund holds. Now, the first thing I notice when I see this is the great access that the fund has to in global sectors and global companies. And it's just not something that you can get on the JSE. And I say this even if you're in Australia or even if you're in Mexico or any in the world, if you're anywhere in the world, you need to have access to global sectors and to global companies. I would say it's the main reason we tell people to invest globally. Now, I'm not talking about moving your money offshore. That's a different conversation. I'm talking about taking your rands, investing it with an SA-based fund manager who invests offshore and has a track record of doing so. Starting on the left, looking at the aerospace and defense sectors, our top-down approach quickly highlighted the strong order books that this sector would experience from the Russian-Ukraine war. Our bottom-up analysis tried to sift out those companies which could translate strong order book or revenue growth into strong free cash flow growth. Rheinmetall, the top one there, is a German arms and ammunition manufacturer. Rolls-Royce Holdings, not the car company, but the engine maker, they make engines for defense and commercial aircraft. And RTX is the world's largest manufacturer of guided missiles. In branded pharma, but specifically Novo Nordisk and Eli Lilly, they are the giants which dominate the anti-obesity market. This is quite a nascent and very fast-growing drug category, and we've seen this translate into strong earnings for both those companies. Energy is a very good inflation hedge, and we hold Total and Occidental Petroleum. In China, the fund has exposure to companies which are both cheap and which screen as high quality, and these companies are also growing strongly beyond the domestic borders. Gold, we've spoken about gold and we've shown the good characteristics that gold has, and for now we agree with central banks that gold is a good holding. We also think that when the Fed does decide to drop interest rates, that gold will do even better from here. Looking at our asset allocation in the Worldwide Flexible Fund, we currently have an 85% exposure to equities. Recently, that was about 72%, and we upped that to increasing 12% allocation to SA equities, specifically to SA financials. And that was a tactical asset allocation going into the elections. We were seeing stronger commodities, which would benefit a stronger rand, which would be good for the equity market, especially the SA Inc. equity market, and we had a favorable view on the outcome of the SA elections. Offshore cash, we have 10% in US dollar cash, which is yielding 4 to 5% in interest in dollars. We have gold bullion, which we hold 5%, and another 2% in gold equities. And for now, we have 0% allocation to bonds. We think there will be a time to hold bonds, but for now, we have a 0% allocation. So, coming back to the three paths that are open to the US, we have assigned what for now is a probability of what we think could happen or should happen in each of those three scenarios. Given that it would be an unpopular choice, we think that there's a 10% probability that the US will actually cut debt. If this happens, inflation will fall and bonds will outperform equities. It is worth noting that this will be the same scenario or same outcomes if you have a recession in the US. Inflation will fall and bonds will outperform equities. In the do-nothing approach, which we assign a 60% probability, the economy can still do well, but it will be fragile. Inflation could still persist and the debt burden will still grow, and at some point that could all collapse. So vigilance is required. If there was a need to raise more debt in case there was a pandemic or a financial crisis or something like that, inflation will spike quickly, rates would have to follow quite quickly, and bonds and equities both will underperform whilst energy and commodities will outperform. The two main funds of the flexible funds, on the left we have the flagship Worldwide Flexible, or the fund of funds. Since inception, it's a 20-year-old fund, 20-year-old plus fund. It has 13% per annum. Inflation over that period has been 5%. Its benchmark has been inflation plus 5%. So it has outperformed its benchmark by 3% for the last 20 years. On the right, we have the flagship Worldwide Flexible Fund, and that has outperformed its composite benchmark as well as outperforming or in line with inflation plus 5%. So a real return of 5% in that fund. So that's it. I want to thank you for your time and for listening to our views on the US debt problem. Please feel free to contact us if you have any questions or if you just want to get in touch. Thank you very much.